Our next guest says that the squeeze in small caps is over. We want to bring in Barry Knapp, managing partner and director of research at Ironsides Macroeconomics. And Barry, got a lot of things to talk about, but we'll talk about with this. We'll start with this point on small caps. Small caps have been up pretty significantly. I forget what the numbers are, 12, 15% in just a very short period of time. So, yeah, it does look like the squeeze is over. I guess the question is, how much more room to run do you think these small cap stocks have?
So typically when we come out of a recession or what I call Fed policy normalization related correction, sort of a mouthful, but the idea is once we come out of a recession and the Fed starts to tighten or normalize policy because they think we've reached escape velocity, you'll get about a 6-month persistent rally in small caps. But generally before you get those, small caps will go down quite a bit. They go down a lot in recessions. They go down, more than, or call it 30% more than the S&P does. The same thing happens in these 10% Fed policy-related corrections. They haven't gone down this cycle. They've been massively underperforming, but they haven't gone down. So for me, sure, the trigger for this rally was the last CPI number and the idea that the Fed's going to start cutting. They should be cutting, next week, but they'll start in September. So that's what triggered the short covering. But there wasn't really an opportunity created by them actually declining to justify a 6-month type persistent rally in the group. And the real reason that they've been struggling so much is still on offer with earnings season thus far, where earnings are still falling for the sector because of the deeply inverted yield curve. They finance at floating rates, and they're getting squeezed on the cost side. I don't see that problem alleviating itself for roughly a year or so. Stocks will generally start to rally 6 months before earnings bottom. So I think this is just too early for a sustainable rally in small caps and small banks for that matter. So for me, it was a squeeze when it was clear the Fed was going to start cutting, but it's just a passing trend, and for most investors, not really worth getting involved in.
What do you like, Barry?
Well, we've been market weight tech through this whole cycle. Being much more than market weight tech and comm services, to me, borders on recklessness, since tech is 30% of the index and comm services is another 10. Our biggest overweights have been energy, industrials, and materials because of the manufacturing renaissance in the U.S., which is a more secular trend than a cyclical one. At this spot right here, for me, the economy is definitely weakening, and there's going to be increasing evidence of that. So I'm in a tricky spot where there's stuff I like from a secular perspective. I still think you should be overweight, but it's likely to struggle. And earnings season so far for industrials is not. It's pretty mixed, but on balance, it's negative, and we're in a sort of a tricky spot. I've been buying some intermediate maturity treasuries as a bit of a hedge for that. But overall, I think this is a spot where adding new money to the market is probably unwise for the next month and a half, 2 months or so.
But
if we get the downdraft, then
prices will drop, and that will present an opportunity.
That's exactly right. And so as we transition to the Fed starting to ease, the justification for that is a weakening labor market, which is going to be increasingly evident. I would expect a fairly weak report a week from Friday. The initial estimate of the benchmark revision for total payrolls is likely to show we created 1 million less jobs in the year ended March. As we go through that whole process, I would expect the market to get really concerned about earnings and the economic outlook, and that to be associated with a bit of a pullback here. So if we get that pullback, it's probably a fat pitch and you can add money. But right now, we know valuations are rich on tech. It doesn't take much for disappointment. Google last night, for example. And so, this is nothing like a fat pitch where you'd say, pound the table, you've got to put some money to work.